Okay. Good morning once again. I will start the class now. Welcome to today's class. Last week we discussed loss relief, and I'm very sure every one of us in this class will understand the topic very well. Today we're going to be looking at trading profit and loss adjustment and how is this topic important? Why is this topic important in taxation? It is very essential that every one of us in this class knows this topic because going forward, this topic is going to be one of the important topics that we're going to be discussing across all the remaining topics that I have with you. After today's class, we're going to be starting capital allowance, and which is going to take us like 2 or 3 classes. I would not want any one of us to miss that class because it's very important, because we're going to be doing some calculations which will be tested, which might be tested by the examiner. Okay. So when you talk about trading profits adjustments, what we are essentially talking about is the profit of the taxpayer and the profits in terms of accounting profits. We're talking about the taxable profit and the accounting profit. There is no convergence between the two. Okay, so accounting profits is a profit that you have prepared based on various accounting standards that we know. Meanwhile, for taxable profits, it is a profit that has been prepared based on tax laws. Now, by implication, it would mean that the accounting profit is different from that of the taxable profits. They are different. They are not the same. They are very, very different. And why is it different? They are different. The two are different because of the various or two different rules that are being applied. Imagine in your financial statements, depreciation is an allowable deduction. When you get to tax, we say depreciation is not an allowable deduction. Why is depreciation not allowable? Why is it allowable? Why is it treated as part of expense or part of expenses in your profit and loss statements? Now, accountants believe that depreciation is an amount that you set aside for the replacement of the assets. Therefore, it is essential that I set a certain amount of money aside so that when these assets eventually are fully depreciated, we have saved some money from our profits that we are going to use to replace or acquire another one. That is what depreciation does, essentially. A taxman will tell you that no, before an expense is allowable or treated as allowable, expenditure must have been incurred, or you must have had a commitment. Meanwhile, financial accounting does not look at it that way. So, taxman will tell you that depreciation, for example, does not involve out-of-pocket fund. You have not spent any amount. Accountant will always tell you that no, depreciation is good so that we can have an effective replacement for an asset. Taxman will tell you that for replacement of an asset, we could talk about capital gains tax. That there is a provision under capital gains tax that talks about the treatment of replacing an asset. That is your rollover relief. So the way an accountant is looking at financial reporting is not the way the tax man is looking at the reports. Now, let's go back to that depreciation that I have explained. Now, for depreciation, you would also notice that there are different methods of depreciation, different methods. When you have different methods of depreciation, what is that implying? It is implying that there's not going to be consistency. Imagine company A and company B acquire the same assets and put it into production use at the same dates. Imagine again that these two companies acquire that same asset and put them into production use at the same dates, and they acquired at 10,000 naira each. Assume company A is using straight line method. Company A is using straight line method. Company B is using reducing balance method. Company B is using reducing balance method. Now, let us also assume that the two of them, they have the same rate of depreciation. Company A uses straight line method. Depreciation will be calculated on costs. In first year, it will be 1,000. Company B is using reducing balance method. It's calculated on book value, 10,000. Second year, this guy, we have 10,000. Second year, this guy, we have 900 on book value, don't forget. Third year, this guy, we still have 1,000. Third year, this guy, we have 810, and so on and so forth. You can see that these two taxpayers that have acquired the same assets and put them into production use at the same dates with the same cost are charging different amount of depreciation. This is inconsistent. In tax, we believe so much is inconsistency. Therefore, we would say that this is not allowable because of the inconsistency of depreciation. You cannot compare both taxpayer using the same parameter. And tax authority likes this comparison. Everything that the taxpayer would do must be seen as constant, must be seen as the same. What company A is going to adopt must be the same as what company B will adopt. So therefore, depreciation was not included as part of allowable deduction. If that is the case, if depreciation was not included as part of allowable deduction, there is a replacement for this under the tax law. And the replacement for this is capital allowance, which we are going to be talking about later. Now, in a nutshell, what we're trying to say here is that for the purpose of computing our adjusted profits, your trading, your financial reporting that you have gotten from your financial statements must be adjusted back to taxable profits so that the divergence between the two can be linked, and you now take that your financial statement that you have and apply the tax principle on the statement to disallow some expenses and allow some expenses, to also allow some taxable income and disregard some taxable income. So as we move ahead, we're going to be talking about difference between adjusted profit and assessable profits. Basically, under Companies Income Tax Act, they are the same. They are the same. But under hydrocarbon tax, they are not the same. Because for assessable profits under hydrocarbon tax, it is going to be under petroleum profit tax, rather, it is going to be your adjusted profits less loss relief. That is that. Now, we move on. We need to see some criteria for which, if we incur the expenses, they are going to be treated as allowable. There are criteria to that. Now, one of the criteria that you need to know is, I've always told my students, when you are treating question on taxation, we have to look at the expenses holistically. And when we are doing this, we have to talk about whether expenses is wholly incurred, exclusively incurred, necessarily incurred, and reasonably incurred. We're going to be talking about this one after the other. What do they mean? So before expense can be treated as allowable, the expenses must be wholly, exclusive, reasonable, and necessary for the purpose of generating taxable income. Invariably, I am saying that your allowable expenses are the expenses that are wholly, exclusively, reasonably, and necessarily incurred for the purpose of generating taxable income. Now, the purpose of generating taxable income is the reason why you have incurred these expenses, so that you can make income on the other hand, on the other side. Now, having said that, we're not going to be looking at it one after the other. What do we mean? What do we understand by wholly? What do we understand by exclusive? What do we understand by reasonable? And what do we understand by necessary? Now, we take it from wholly incurred. When we say an expenses is wholly incurred, that means the entire amount, underline the entire amount in your notes. The entire amount of that expenses must have been incurred for the purpose of the business. That is, no portion of these expenses is shared, is not allocated to any other business segment. The expenses is incurred solely for the business. The Zoom license that we are using here is only for the purpose of this online class. So we are going to treat it as allowable expenses, because without giving you this kind of platform, you might not be able to receive your lecture. Therefore, we say incurring expenses to obtain this license for the projection of this lecture is a only incurred expenses for the purpose of this business. So we are saying that the entire amount of these expenses must be incurred for the purpose of the business. The next one is exclusive. When you say exclusive, business alone derives benefits. Business alone derives benefits. Then the expenses will be treated as allowable expenses. So I'm actually looking for a good example of that. Okay, let's take this. When we acquire marker to teach our students in the class, the only business benefiting from that is our students and our class. We must incur marker, we must buy marker. Without marker, we cannot work on a physical class. So we are saying that the business alone is benefiting from that expenses. Salaries and wages, the system alone is benefiting from that expenses. When we pay our lecturers their lecture fee, it is exclusively for the purpose of teaching, which is invariably generating income for equity professionals. So that's what we are trying to say. The next one is necessarily incurred. Without incurring these expenses, the business cannot function. We say the expense is necessary, because if you do not incur these expenses, the business cannot function effectively. I have cited an example of lecturer fee. The next example that I have to cite now is rent for the physical class. Imagine that we did not pay our rent. it will become impossible for us to derive our income. So we must pay rent. So without paying rent, we cannot use where we are using in our VI center for our lecture. We cannot also use where we are using in our Esolo center for our lecture. So we are saying, without incurring these expenses, the business cannot function well. That means the expenses is reasonable, sorry, it is necessary. You must incur it. You must pay your lecturer. You must incur data costs. You must also incur for online class. You must also incur license. You must pay for licenses. So we are saying that these expenses are necessary because without incurring these expenses, the business cannot function effectively. Now, reasonability. Now, reasonability has to do with what is fair and not excessive, considering some factors. Materiality. What is the amount that you incurred in the prior year? In the prior year, you have incurred some certain level, some certain expenses. In this year, you're now saying that that expense that you incurred last year, it is 100% increments. We say that expenses is not reasonable because comparatively to last year, you cannot tell me it's 100%. But in Nigeria of nowadays, all this theory does not work. You know that the cost of living now has gone up. Our expenses from last year compared to this year has gone up. So they are not the same. They are not the same. So this point might not really catch it again because of our general business environment or the general environment that we find ourselves. The next one is the industry practice. What is obtainable in the industry? The next one is comparative amount of the same expense in the prior year. We've talked about that. And general business environments. So what is happening in the environment? What is happening in the business environment is very key to understand the reasonability of an expenses. Now, I having said this, the examiner will not be asking you at this level that explain allowable and unallowable expenses. No examiner has time for that. They go into testing the intricacies of all these things that we have talked about. We move on to, let's see how the format looks like. Now, this is format, for example. Now, when you talk about adjusted profit, I have told you that you are adjusting the profits of the accountants. You are adjusting the profit of accountants to be taxable profits. Do you understand? So that is that. Now, this is the accountant's profits. The profit of the accountant or profit before tax. So if you are given a financial statement, so the profit before tax is very essential. So you look at the profit before tax. If you are given net profit, you take the profit. But if you are given a complete or comprehensive financial statement, your profit before tax is what you're going to see. So you take profit before tax. Now we add allowable expenses incurred in the accounts, and you also add taxable income omitted. The first thing you add is non-allowable expenses included in the account. We have said the expense is not allowable, and you have gone ahead to include it in the account. What would that have done to our profit? Say no. What would that have done to our profit? We said this expense is not allowable, okay? But you have gone ahead to include it in our profits. What is the effect of that on our profits? Say no. Zainab, what is the effect on our profits? I'll mute your mic and talk. Is Zainab in this class? Zainab. Okay, can any other person hear me? So that it won't be as if I'm the one talking, I'm just talking, nobody's
Yes.
here.
Yes, we're here.
Okay. So who can tell me what the effect of that is? Zainab, this is not fair. I remember that I've called you severally. Yeah, I've never spoken in this class. This is not right. If you're in this class, you need to participate effectively so that we can understand, so that we can know that what we are teaching is really getting into you. It is not fair that I'll be calling your name and you will not answer me. This is not right, and this is not professional. I have to put that to everybody. And going forward, I'll just keep to myself. I will not be calling you out in the class again. Any other person, please?
If an expense
Yes,
is
sir.
included in the account, go ahead, please.
Go
Okay,
ahead, please.
it have reduced our profits.
It has reduced our profits, and by implication, what does that mean? To correct that, what do we do?
You also,
We have to add it back.
okay,
Good. Robin, you want to say something?
I think she's answered it. Just to add, ultimately reduce the profit and therefore reduce the tax calculation in the accounting records. So for the tax man, you have to add it back.
Good. So the same thing with taxable income omitted. What has it done to our profits? What has it done to our net profit? Taxable income omitted. What has it done to our profits?
Like the taxable income omitted,
Yes.
right?
Yes.
Okay, so what it did was to reduce the profit. It reduced the profits in the accounting
So
record. So for the tax man, you have to add
what
it
do
back.
we do? We have to add it back.
Add it back, yeah.
Add it back. Good. Anthony, good. The next one is non-allowable expenses. Sorry, allowable expenses omitted. What has it done to our profit before now?
It increased the profits. So for the tax man, you deduct it. Yeah.
Good. What about non-taxable income included in the account? What has it done to our profit before now?
Yeah, the same thing.
No, I don't want something. What has it done? What has that profit done?
Increase the
Non-taxable
profits.
income, it increased the profits. So correct, what
And
do we
therefore,
do?
to adjust it by the tax man, we have to deduct it.
Good, good, thank you. So that is it. We'll move on. Now let's now start looking at the non-allowable expenses that we could see. There are various of it, but I've been able to list some here, so we discuss them in the class today. Now, the first one that you have here is capital expenditure. For capital expenditure, we all know that the purpose of preparing our financial statements is for us to be able to recognize only the revenue expenditure, right? And you remember we have two types of expenditure. We have the capital expenditure and the recurrent expenditure or revenue expenditure. The capital expenditure are the expenditure that is more than a fiscal year. And therefore, they are going to be capitalized and put into the statement of financial position. However, for recurrent or revenue expenditure, they are expenditure that falls within the year. It's within the year. So by implication, we are saying that any expenditure that is within the year will be treated as allowable. Meanwhile, any expenditure of capital in nature that goes beyond 1 year will not be allowable. Now, there are some examples of capital expenditure that you need to know. One of these examples are is one of these examples is when refurbishment of an asset. Refurbishment is capital expenditure. It will not be treated as a liable. And what is refurbishment? Refurbishment is the same thing as overhauling of fixed assets. Overhauling of fixed assets. What do you mean by overhauling of fixed assets? Any expenses that you incur in bringing the assets, in extending the useful life of the assets, you have overhauled it. Okay? Any expense you incurred in extend the useful life of the assets, it means it's been overhauled. So example of that is when you replace the engine of the vehicle. When you replace the engine of a vehicle, that means you have indirectly extended the useful life of the assets. You have indirectly what? Extended the useful life of the assets. So that means that cost will not be a liable reduction. So I'm telling you now that refurbishment, overhauling of fixed assets is not allowed. But you know there could be maintenance, repairs. Repairs of fixed assets are allowable. Okay? Repairs of fixed assets are allowable. Now, having said that, we also talk about any expenses that you incur prior to the utilization of the assets is not allowable, because those expenses are to be capitalized. So when you incur an asset and you call someone to come and help you fix the asset, installation costs is not an allowable reduction. Okay, let's continue. So sorry about that. The next one is private expenditure. So before we went to private expenditure, I was talking about any expenses you incur to bring the asset to life is not allowed. And the example of that is installation cost. Any cost that you incurred prior to the usage of the assets, like for example, um, um, freight charges, import duty, value-added tax paid on the assets when you acquired it, they are not allowable expenses. Okay,
Constructing the asset.
all these, yes, all these costs should be capitalized. You have done PPE, and I'm very sure they must have taught you that in your PPE if you have done it. But if you have not done it, they will still teach you. So they must be capitalized. So those will be capitalized. The next one is private expenditure. Private expenses are not allowed at all. So when you see any private expenditure, they are not allowed. The next one, provisional item. In tax, we don't believe in provisions. We believe in, what is it called? We believe in, you must have incurred the costs. So when you are making provision in tax, provision is not allowable. Okay. The next one is depreciation. We have said depreciation is not allowable. The next one is food, wine, and liquor. Anybody that you want to give your work to, they must have eaten in their house. Why are you giving them food? So we said such entertainments will not be an allowable deduction. The next one is legal expenses. For legal expenses, what are we talking about here? Your legal expenses are allowable ordinarily. But when it now comes to legal expenses by incur with regards to tax appeal, with regards to what? Tax appeal, whether it is successful or unsuccessful, it is not allowed. It is not allowed. Whether it's successful or unsuccessful, it is not allowed. So that kind of expenses is not what? Allowed. So that is that. Whether you've taken the tax authorities to court, they are asked to pay a certain sum of money. You believe that that amount was not calculated rightly, and the tax authority is fixated that is what they are going to charge you. You say no, I'm not going to accept this. So you headed to court, and in the court of law, you won the case. Whether you won the case or you did not win the case, such is not allowable expenses. The next one. The next one. Fictitious assets, goodwill, preliminary expenses. All these are not allowable. Okay? They are not allowable. The next one. Losses recovered under insurance or contract of indemnity are not allowable. Loss on disposal of fixed assets are not allowable. Payment to an unapproved pension fund are not allowable. Loss on investments are not allowable. Any withdrawal out of capital not allowable. Defalcation is not allowable. Staff loan written off not allowable. Customer loan written off not allowable. You are not bank. You can't be writing off loan. Any appropriation item not allowable. Stamp duty and registration expense incurred in bringing business into an existence, they are not allowable. Appropriation item, all are not allowable. Taxation, transfer to reserve, dividend, they are not allowable. Losses, lease agreements are not allowable. Now, basically, we have two types of leases. We have the long-term lease and the short-term lease. For the long-term lease is allowable. Sorry, is not allowable. Short-term lease is allowable. When I say allowable here, I mean the renewal of short-term lease. The renewal of short-term lease is allowable. Meanwhile, the renewal of long-term lease is not allowable. So let's continue. I'm sorry about that. So as I was saying, I said we have long-term lease and short-term lease. Acquisition of long-term and short-term lease are not allowable. Acquisition are not allowable. Renewal of long-term lease is not allowable. Renewal of short-term lease is allowable. I'll say it again. Renewal of long-term lease, not allowable. Renewal of short-term lease, allowable. Acquisition of new lease, whether short or long, are not allowable. The next one, any form of tax liability, any form of tax, whether it is withholding tax, or whether it is company income tax, whether PAYE, whether capital gains tax, whether PPT, they are not allowed in the income statement. The one that is allowed is value-added tax on expenses. You remember when you pay your electricity bill, there's going to be value-added tax that will be charged on the electricity bill. That will be expense, okay? And that will be charged against your income in arriving at adjusted profits. Do you understand? So that is that. The next one is subscription. Subscription are generally non-deductible into the account unless the expenditure is for the benefit of the company. So ordinarily, the only subscription that are liable are the subscription to trade and professional bodies. Subscription to ICANN is allowed. NIM, that's in that you guys usually collect when you go for service, is allowed. Subscription to Nigerian Society of Engineering is allowed, and so on and so forth. All those subscriptions are allowed, provided they are subscription to trade, recognized trade association, like Lagos Chamber of Commerce is allowed, and professional subscriptions are allowed. Do you understand? So that is that. So we'll move on to the next one, bad debts. Bad debt ordinarily is allowed, but there must be some criteria to be followed. Number one, before debt is allowed, it must be a trade debt that is arising from trading activities. That is arising from what? Trading activities. Number two, the debt must have been included as part of sales in the year of occurrence. In the year it occurred, it must have been part of sales. The taxpayer must have undertaken all reasonable steps to recover the debt. You can't just say a debt. I want to call it a debt without you taking all reasonable evidence, all reasonable steps to recover the debt. You have to take all steps that is reasonable to recover the debt. You can't just leave it hanging. The next one is no portion of this same debt must have been deducted in the previous year. Don't come and bring last year debt and bring it to this year and say you want to deduct it. No. It has to be concluded. Now, before you say a debt is concluded as debt, there must have been a conclusive litigation on the debt. Conclusive. That means you have taken every reasonable step, you have gone to court, and you could not recover the debt again. Then it is going to be treated as bad debt. Now, donation. Donation is also allowed, provided the donation is to the bodies listed in Schedule 5 of CETA. The next one, any expenses incurred in deriving tax-exempt income. This is the effect of 2019 Finance Act. All this, effect of 2019 Finance Act. Now, we are saying that you have some income that are exempted from tax. Okay? And you have incurred expenses on this income exempted from tax. Any expenses you incur on the income exempted from tax shall not be an liable deduction. Because the income that generated this is already exempted. Why are we including the expenses that we use that was incurred to generate the income? Why are we also including it in our income statement when we know that the income is already exempted? Do you understand? Such an income will not be what? Allowable. The next one, the compensatory payment made by borrower which qualifies as dividend is not also allowable, and so on and so forth. Now, the next one that is very important that we know, that we need to know, is your bad doubtful debts. Doubtful debts are divided into two. We have the specific debt and general debt. When I say specific debt, there are some debtors that we can trace. We know them specifically. We can trace them, then those are specific debtors. Now, because you are a specific debtor, or that person is a specific debtor, that debt, if we make provision for it, is going to be an liable deduction. And that is one of the things that bank does these days. Bank will do know your customer. They want to know all the customers that they have. And that is why if you open a bank account today, the bank will tell you, give us your address. We want to come to your house. We want to know the landmark that is closer to your house. For example, may I stay in somewhere in Nigeria? Now, when you look at that, they will tell me what is the landmark to your estate. I will say, okay, the landmark to my estate is maybe a Kota shopping complex, maybe Aso Rock, maybe this. So I will tell the bank so that when the bank wants to come and verify where I stay, they can easily trace me to that place. So the same thing, there are some debtors that are known to the seller or to the company. So these debtors, they can easily trace them if they are unable to get their money back from the debtors. So they can trace them. So it's the same thing. In this regard, they will be traced. So any provision you make for this kind of debtors will be allowed. What about a debtor that you cannot trace? You don't know their whereabouts. You cannot say, this debtor, I know him very well. I can trace him and get my money back from him. Such a debtor is not going to be allowable. Sorry, such a debt will not be allowable, because when you make provision for that, you are just making provision for some people that you don't even know. You don't have idea of who they are. So you can't make a general provision. The provision has to be specific. And that is that. We'll move on to the next one. What about non-taxable income? Non-taxable income included. We talk about sales of fixed assets is not allowed. It's not taxable income. Sales proceeds from investment is not taxable. Profit on disposal not taxable. Any reversal into income of previous disallowed expenses is not allowable. We have disallowed this before. We now say, okay, we reversed it. So we're saying it's not allowable. Dividend is not allowable. Interest on federal government bonds, not allowable. Treasury bills, not allowable, not taxable rather. And promissory notes, all those notes, they are not taxable. We talk about dividend, interest, rent, or royalty derived by a company operating from outside Nigeria, and the income is brought into Nigeria through an approved channel. A company is operating outside Nigeria, okay, and generates income on dividend, rent, royalty, and interest. Any income of such that is brought in through an approved domiciliary account, that is brought in by approved channel, which is a CBN, such will not be taxable income. Illegal income, such as bribe, will not be allowed, and any exempt income will not be taxable too. For those of you that you don't have my textbook, it is essential you have it. Let me also share it for you. This is the cover of the textbook. Can you see the cover of the book?
No.
No, okay. I want to share it so that you can see. So for more reading, this is the book. So this is the 4th edition. If you need it, do not hesitate to let me know. We can make an arrangements as to how you will get it. SFM textbook is coming out very soon, which is done by Mr. This one is 16,000. 16,000. If you are interested, it's about 800 pages, so it's not a small book. Okay, so that is that. Let's continue with our class. So we now need to go and look at some calculation. Let's quickly do some calculation. We're going to do like 2. And we'll call it a lecture today. So, illustration 1 or illustration 2. Someone should help us read it out. Illustration 2. Someone is helping us read. Nobody's helping us read the question.
So let me read.
Thank you, Deborah. God bless you.
Mr. Bank, Mr. Bank Olemo, who has worked in a neighboring African country for many years, returned to Nigeria in August 2018. He incorporated a private limited liability company known Bank Moon Limited, located in Lagos on October 30th, 2018. The bank deals in processing and packaging of plantain chips for local consumption. The director of the company opened a business bank account with one of the leading commercial banks in November 2018. The company commenced full operations on January 2nd, 2019. Your firm, Tumini and Co., was appointed as the tax consultant to Bank Moon Limited in January 2021. At the first engagement meeting with the company, we discovered that the company was yet to register with the Federal Inland Revenue Service. Relevant taxes, including value-added tax, were not remitted to FIRS. An extract of the company's first set of financial statements made up to December 31st, 2020 as follows. No need for the figures, right?
Just hold on. Just hold on. Now, whenever you have a question and examiner put this clause, your firm was appointed as tax consultant, you have to write a report when you are answering this question. You have to write a report. You have to write a report and send to the tax authority. Sorry, and when you are writing your solution, after you have done your computation, you must write reports. Okay, and addressing this question in the like manner. Okay, so let's go. You are given the extract of the financial statement of the company. So the first thing you will do, let's go to the additional information one after the other. When you have a question, first go straight to the additional information. You'll see what we need to do. You see what we need to do. Now, Lagos Chamber of Commerce, 750,000. I've told you subscription to this kind of organization is what? Is allowable, right? So this is going to be allowable. Motor Boat Club, is this allowable or not? Please unmute yourself now and start talking. Motor Boat Club, is it allowable or not?
It's not allowable.
Not allowable.
Polo Club, allowable or not?
No.
Not allowable.
Political party, allowable or not?
No.
Not allowable.
Approved National Relief Fund, allowable or not allowable?
Yes.
Allowable.
Good. Now, this donation and subscription was from this donation and subscription. Do you understand me? So that is the details of this 9.3 million. Do you understand? We move on to the next one. Bad and doubtful debt consists of the following: allowance for doubtful debts, allow or not allow?
No.
Not allowed.
Specific, allow or not allow?
Allowable.
Yes.
Okay, the next one. We go. Miscellaneous. Court fine. Allow or not allowable?
Not allowable.
No.
Why is court fine not allowable?
Because it's not directly attributable to the profits.
Okay. What of if that person, when he was going to get a contract for the company, that was when he got fined?
I was looking at this court fine as a penalty. That is
Good.
what I'm looking at it. And if it's a penalty, it's not allowed. Court fine.
Good.
Not allowable. Yeah.
You said?
I said it's not allowable. The fine,
No,
they
it's
attracted
not
the
allowed.
fine. It's a penalty to them, so it's not allowable.
Yeah. Any act that you did that is contrary to public policy
Yeah.
is not allowable. Okay? So we are not going to allow that. We move on to the next one. Exchange losses on remittance and balances. Allowable or not allowable?
Not allowable.
In my opinion, this one is
Not
tricky.
allowable.
The exchange, this
It is not
I
allowable.
was going to make a
It's not allowable. The next one. Allowable
the
expenses.
exchange loss. Can I go back to the exchange loss? If the exchange loss is realized, that is real, in the course of
Yes.
the normal trading of the company, is real, not a provision now. Would it be allowed?
It should be allowed.
Exactly, yeah.
It should be allowed. But in this regard, it is not, we are not informed whether it is realized
Yes.
or not.
Exactly, yeah.
The next one. Loss of fund, director of the foreign company, allowed or not allowed?
Not allowed.
Allowed or not allowed? Director of the foreign company of 9.8.
Not allowed.
Not allowed.
Not allowed.
Next. The next one is debt collection and retention fee, retainers fee, allowed or not allowed?
Allowed.
Debt collection and retainership fee, allowed or not allowed?
Retainership fees.
Retainership.
The debt collection, in my opinion, the debt collection fee is allowed. The retainership is
Not allowed. I don't see any allowed.
yeah, the retainership, I don't understand. The retainership is not allowed.
Okay. What about land acquisition?
Land is capital in nation, so it's not allowed. It's capital this thing now.
Okay, let's go back to that
Okay,
debt collection and retainership.
Okay, can we go back to that debt collection? The debt
Yeah,
collection,
so-
I know they put it together. The debt collection
Yeah.
should be allowed. The retainership should not be allowed.
Okay, Robin, you are not correct. Debt collection is fine, retainership too is fine. Let me tell you what retainership means. When you engage a lawyer, every year you must write to them that I still need your service or not. So holding them on for you at any point in time, you have to pay retainership fee. That's number one. Number two, all this firm usually collect retainership fee, isn't it? Okay, now you know. All these firms usually collect retainership fee. For those of you that you are working, your auditors, every year you have to pay them retainership fee so that they will continue to have you in their calendar in that year so that they can know that, okay, we are working for this person also this year because we have retained them. You are paying that retainership fee. The same thing with hospital. All this HMO is like a retainership fee. If you did not pay, if you don't pay your HMO, your staff will not be covered. So it's retainership. So you must pay it at every time. Okay? So retainership is allowed. So the examiner said, what is the due date for filing audited financial statement to the tax authority? State the base of assessment for company just commencing operation, and compute the adjusted profit relevance here. Okay. Now, I haven't done all this. You have analyzed the adjusted information. The next thing you do is to go back to the body of the question and start looking at it one after the other. Profit or disposal, is it taxable income or non-taxable income?
Non-taxable.
It is non-taxable income. We have talked about this. Salaries and wages, allowable or not allowable?
Allowable.
Allowable.
Director's remuneration, allowable or not allowable?
Allowable.
Electricity and generator already explained, allowable or not allowable? Allowable or not allowable? This one.
Allowable. Allowable.
Rent and rates.
Allowable.
This one, repairs and renewal, allowable or not allowable?
Allowable.
Motor vehicle expenses, allowable or not allowable?
Allowable.
Donation and subscription, we have treated that, right?
Yes.
Interest and bank charges, allowable or not allowable?
Allowable.
Allowable.
Bad debts, allowable or not allowable?
Specific is allowable now.
Yes.
No,
we have
the
treated
doubtful debt is
that.
not allowable.
Yes, it is allowable. Bad and doubtful debts. When you see bad debts, ordinarily it is allowable. Okay. But when you
doubtful.
now see them separately, like this one now, you have bad debts consists this question. We need to adjust this. This is supposed to be the
Exactly.
entire value you get that we have here. But unfortunately, we have less. Okay. So that is noted. It should be corrected. We can just increase the specific to increase. Okay. So we said bad debts. We are given the details of these bad debts, which is supposed to, okay, yeah, which is supposed to be 8.8. But what we have here is not the same. So it's an error, but it's fine. We can correct that later. So we are saying that this bad debt is allowed, but if you are now given the further details, that's why we now continue to check the details. Now we are given details. So what is not allowed here is the general debt. This one, allowance 3,000 is not allowed. So we now go back to the body of the question. So the solution now, you can see both club that we talked about that time, motor club, political party, bad debt, court fine. We have taken them, loss to director, land acquisition, depreciation is not allowable, remember. And this one is not taxable. So these are our adjusted profits. Do you have any question on that? The next one is Fortune Nigeria Limited, a reputable soap making company, is based in Lagos and registered over 10 years ago. The financial year end of the company is 31st December every year. And the financial position of the company for the year ended 31st December 2017 was as stated below. We have this turnover 100K, cost of sales 65, gross profit, we have that. So just like we have always said, we need to first go to our additional information. The first thing, the additional information that we have here is included in the other income was 850,000 and as profit on disposal of fixed assets. Is it a taxable income or not?
Not
It's not
taxable.
taxable. Should be deducted.
Good. Not taxable. The next one, salaries and wages. Included a sum housing allowance of 10 senior staff and were paid the sum of 200,000 each. Is it a taxable income? Is it a liable expense or not?
What?
This number 2.
Not allowable.
This number 2, my dear students, is just for information's sake. Nothing will be done to it. Okay? So they are just giving you the breakdown of the salaries of the senior management. Though this will be taxable under personal income tax, not under. Do you understand me? In the hand of each of the senior staff, the tax authority will tax that in personal income tax. The next one.
Exactly. Yeah.
1/4 of the expenses on rent was paid on the apartment occupied by the father of the managing director. Allowable or not allowable?
Not allowable.
So what are you doing? If we say it is not allowable, so that means
adding back
1/4, that is 1/4 of the managing director's expenses. Sorry, managing director's rents will be affected. Abi? It will be affected. Good. If that is the case, I'm sending a question to your class, which is going to be your assignments. So if that is the case, 1/4 of the expenses that was not allowed will be treated as salariable expenses. Because it is rent, if this property, if you are given the question that they have the pay tenement rates, 1/4 of it will be disallowed. If you are told that they use lights, electricity, 1/4 of the electricity will be disallowed. Do you understand me? The next one. The next one is half of the advertisement cost was incurred on sponsorship of television program where airtime was allocated for promotion of the products. Is it allowable or not allowable?
It's allowable now.
Allow or not allowable?
It's allowable. I'm seeing that thing as just promoting the advertisement cost or whatever. Promoting the.
It's not allowable.
It is not allowable, Deborah. Okay, why? Debbie, why? Okay, because Debbie is shy away, it is allowable.
It's allowable now.
It is allowable, and I'll tell you why it is allowable. Okay, as I was saying, it is allowable. And why is it allowable? I will tell you now. Now, half of advertisement cost was incurred. Look at that value statement. It was incurred. So the fact that it was incurred means it is allowable. They have spent the money. You will see, let's see the other one. Public relation and advertisement of 3,150,000 incurred, included the sum of 308, paid as sales agent's commission. Is it allowed or not allowable?
It's allowable.
D or A?
It's allowable, sir.
Disallowable.
PR.
Okay. Just say
PR is not
taxable or
allowable.
so deductible or non-deductible. Is it a deductible
It's
expenses or
deductible.
non-deductible?
Deductible.
Good. Yeah, so this is also for information's sake. It's already included in this value. And when you look at 3,150,000, it's already part of your, you can see it. So they told you that out of this 308 was paid to as commission to the sales agents. The next one, breakdown of miscellaneous expenses include the following. Cost of computer hardware, 680. Is it allowable or not allowable?
Not allowable.
Not allowable. What about this furniture? Allowable or not?
Not
Not
allowable.
allowable.
Cost of lubricants, allowable or not allowable?
Allowable.
Allowable.
Printing, allowable or not allowable?
Allowable.
Allowable.
We go again. The next one, donation and gifts include the following. Egba community for town hall developments.
Not
Allowable
allowable.
or not allowable?
Not allowable.
Allowable or not allowable?
Allowable.
That's what I want to hear. It is not allowable.
Mm.
Donation to Egba community. What concerns us with Egba community? It is not allowable. Donation to University College of Ibadan. Allowable or not allowable?
Allowable.
Allowable. Gift to gubernatorial candidate. Allowable or not allowable?
Not allowable.
Not allowable.
We go on. The next one. Substitution of staff to issue of your account of Nigeria. Allowable or not allowable?
Allowable.
To trade association. Allowable or not allowable?
Allowable.
Institute of Management Accountant. Management. Allowable or not allowable?
Allowable. No.
So we have done with the question. We now go back to the body of the question. We'll now go and look at it one after the other. Which other thing that they've not talked about that is not supposed to be allowable here? Depreciation is not allowable. And that is all. So we'll now go to the solution. In the solution, you will notice that this first one, we talked about this, profit on disposal disallowed. 1/4 of the rent disallowed. Cost of computer hardware, furniture disallowed, Egba disallowed. So we now have our profits, adjusted profits. So that's how to do the adjusted profits. That's how to do adjusted profits. So you have the notes with you. Go through it. If you have any question, you are free to ask me. So that will be the end of today's class. Now, study this other one that I've included here. If you have any question, you can ask. This is comprehensive enough for you to understand. And I'm also going to send you an assignment. For those of you that have not been doing assignments, continue. So,
hello, sir.
That is,
hello, sir.
Yeah.
Not actually that all of us are not doing the assignment, but if I remember that the last assignment I did, I don't know where to send it to.
My WhatsApp, uncle.
Okay, your WhatsApp.
Yes, now.
Actually, okay, but I don't actually have that number. That's the reason. Because I wanted to ask.
Where is Shemu Davis?
Sir?
2 people did the last assignment, or 3 people did the last assignment.
Okay, I don't know that your number was there now to send it to.
My number did here, my brother.
Okay, sir.
So do your assignment and scan it to me. I
Okay,
am
sir.
responding to those that have done the assignments.
Okay.
I will respond to them today.
As well.
So I'm sending you another one today. So expectation is that you will do it and send it to me.
Okay, sir.
All right. Have a nice day. Go and relax for your next class.